All right, let's pull back the curtain on one of the biggest secrets in finance. It's a system that affects your life every single day, but honestly, most of us don't really get how it works. I'm talking about banks. Not just how they store your money, but how they really work and, yeah, how they make billions from it.
Think about your bank account for a second. You check the app on your phone, you see a number, and you just kind of assume that your money is sitting right there, doesn't it? Tucked away in some super safe digital vault, just waiting for you. But have you ever stopped to ask yourself, where is that money, for real?
Yeah, well, the short answer is, it's not there. Seriously. Right this second, a big chunk of your money is probably out there somewhere else. It could be helping someone buy a car, or funding a new business, maybe even paying for a house. So, wait, how can your money be in your account and somewhere else at the same time? Well, that is the magic trick we're breaking down today.
To really get how this all works, we need to jump in a time machine and go way back, like 500 years back, way before we had the kinds of banks we have today. So, picture this. Back in the day, if you were wealthy, you had gold. But gold is, well, it's a hassle, right? It's heavy, it's risky to just keep lying around the house. So what did people do? They took it to the local goldsmith. He had the strongest vaults, so he was the safest bet. He'd take your gold and give you a little paper receipt, basically an IOU, saying, yep, you've got this much gold stored with me. And pretty soon, people figured out it was way easier to just trade these paper receipts instead of lugging all that heavy gold around. Everyone knew the paper was backed by real gold, so it was just as good.
And this is where the goldsmith had his big aha moment. He's sitting there day after day, and he starts to notice something. Most of the gold, it just sits there. It never moves. On any given day, maybe only, say, 10% of the people actually came in to get their physical gold back. The other 90%? It was just collecting dust in his vault. So a little light bulb goes off over his head. He thinks, wait a minute, what if I, quietly, lend out some of this gold that's just sitting here? I could charge a little interest, and as long as I keep enough on hand for the few people who show up each day, nobody would ever be the wiser. And that one sneaky, brilliant idea, that was it. That was the birth of the entire system we now call fractional reserve banking. It's kind of crazy to think about, right? That simple little trick, that goldsmith's secret, became the blueprint for our entire global financial system. It evolved from a quiet side hustle into the massive, super-regulated, multi-trillion-dollar banking industry that we all use today.
So let's fast forward back to the present day. That old goldsmith's trick isn't a secret anymore. It's now a very official, very powerful system. We call it the money multiplier effect, and it's the engine that literally fuels our entire economy, all starting with your deposit. The whole thing still runs on that exact same principle. We just call it fractional reserve banking now. Here in India, the RBI, that's the Reserve Bank of India, tells every bank, hey, you have to keep a certain percentage of all the money people deposit with you. That little slice is called the cash reserve ratio, or CRR. But everything else, all that other money, the bank is totally free to lend it out. So let's walk through an example to see how this chain reaction works. Let's say you go and deposit 1,000 rupees in your bank, okay? Now, if the reserve requirement is 10%, the bank has to hold on to 100 of your rupees. But the other 900, they can lend that out, and they do. The person who borrows that 900 rupees goes and spends it, and whoever they pay deposits that money into their bank account. Now that second bank has 900 new rupees. So what do? The exact same thing. They keep 10%, which is 90 rupees, and lend out the other 810. This cycle just keeps going and going. A new loan becomes a new deposit, which becomes another new loan.
And here is the mind-blowing part. That single 1,000 rupee deposit you made, through that whole ripple effect, it can end up creating up to 10,000 rupees of new money in the economy. And get this, the bank didn't print a single new bill. They literally created money out of thin air just by issuing loans.
And that's why, if you think about it, most of the money in the world today isn't actually physical cash. It's not paper notes or coins. It's just numbers on a computer screen. It exists only as digital entries in a bank's ledger, and it was created moment by moment every single time a bank gave out a loan.
Okay, so we've established that banks are basically money creation machines, which is pretty wild. But the next logical question is, how do they make a profit from this? How do they turn that power into billions? Let's get into their business model.
Well, their number one trick is something called the interest rate spread. And honestly, it's super simple when you break it down. They take your money, for which they pay you a pretty low interest rate, let's say 3% on your savings account. Then they turn around and lend your money out to someone else for a much, much higher rate, like say 8.5% for a home loan. That difference, that gap between what they pay you and what they charge someone else, that's pure profit for the bank.
There's a fancy finance term for this, of course. It's called the net interest margin, or NIM for short. And if you ever want to know how healthy and profitable a bank is, NIM is the #1 thing you look at. It's really just the Goldsmith's old trick, but perfected, scaled up, and running 24/7.
And you can see this playing out with real banks in India. You take a big private bank like HDFC, for example. They usually have a pretty healthy net interest margin, and they work hard to keep their percentage of bad loans, what they call non-performing assets or NPAs, really low. Then you look at a public sector bank like SBI. Their margin might be a little bit lower, and that's partly because they also have a job to do for the country, like lending to farmers, which can sometimes be a bit riskier.
But it's not just about the interest rate spread. Oh no. Banks have gotten incredibly good at finding other ways to make money off of you. Think about it. All those fees, right? Account maintenance fees, loan processing fees, even ATM fees. Then they get commissions for selling you things like insurance or mutual funds. And don't even get me started on credit cards. They're an absolute gold mine. The bank gets a small fee from the shop every single time you swipe, and then they charge you massive interest if you don't pay your bill in full. But this whole system, as powerful as it is, has a built-in weakness, a kind of Achilles heel. If the bank has loaned out 90% of all the money people have deposited, what happens if everybody panics and wants their money back, all at the same time? Well, that nightmare scenario has a name. It's called a bank run.
And we saw a crazy, real-world example of this not too long ago with Silicon Valley Bank back in 2023. Some bad news about their investments hit, and panic just exploded on social media and in private chat groups. In a single 8-hour window, people tried to withdraw $42 billion. The bank just didn't have it. And just like that, a 40-year-old bank that was the 16th largest in the US was gone, wiped out in 48 hours.
Now, I know that sounds absolutely terrifying, but before you panic, you need to know there are some really strong safety nets designed to stop that from happening. Here in India, for instance, your money is insured by something called the DICGC. It covers you for up to 5 lakh rupees in each bank. Plus, the RBI can step in as a lender of last resort. Basically, they can give a struggling bank a cash injection to calm things down. So for you and me, our everyday savings are actually very, very safe.
So, okay, now you know the secret. You understand how the banking machine actually works. So the big question is, what do you do with this information? How can you make it work for you? Let's talk about 3 smart money moves you can make starting right now.
First things first, you have to recognize that your bank is making way more money off of your money than you are. So once you have your emergency fund sorted, that's non-negotiable, stop letting huge amounts of cash just sit there in a low-interest savings account. You need to put that money to work. Get it into investments that can actually beat inflation and build your wealth.
Number 2, you need to respect the power of compound interest. It's the bank's greatest weapon, and they use it to make a fortune from you on loans. Your job is to flip the script. You need to make compounding your best friend by investing consistently instead of letting it be your enemy by staying in long-term debt. And number 3, this one's just a super practical, smart tip. That government insurance we talked about, the DICGC, it covers you for 5 lakh rupees per person per bank. So if you're lucky enough to have more than that saved up, don't keep it all in one place. Spread it out across a few different banks. That way, every single rupee you have is fully insured. It's a simple move that gives you total peace of mind.
So there you have it. The whole system is basically designed to use your money to make the bank more money. But here's the thing. Now you know how the game is played. You know the rules. So the only real question left is, how are you going to use this knowledge to your own advantage?